EPK Capital presents Daily Brief for 4th September 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your host Rutvik. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. The Global Market Pulse, a study in Divergence. The past 24 hours in global financial markets were characterized by a complex and often contradictory narrative, a tug-of-war between diverging sector performances, shifting macroeconomic indicators, and persistent political uncertainty. While the U.S. stock market saw its major indices close in a mixed fashion, other global markets displayed their own unique resilience or vulnerability to these overarching trends. This briefing aims to dissect these movements, providing a comprehensive analysis of the forces at play. On Wall Street, a clear split emerged. The technology-heavy Nasdaq Composite led the charge with a robust gain of 1.02%, closing at 21,497.73 points. The S&P 500 also finished in the green, rising 0.51% to 6,448.26 points. In stark contrast, the Dow Jones Industrial Average slipped, closing down 0.054% at 45,271.23 points. This divergence hints at a deeper story of investor sentiment flowing into specific sectors while remaining wary of the broader economic picture. Elsewhere, international markets painted a similarly varied picture. The BSE Sensex in India showed notable strength, rising 0.55% to a close of 81,013, while the Nifty 50 also gained 0.43% to finish at 24,822. In Europe, major benchmarks like the UK's FTSE 100 and Germany's DAX traded in positive territory, gaining 0.13% and 0.44% respectively. Asia, however, was mixed, with Japan's Nikkei 225 surging 1.57%, while indices in China and Hong Kong saw declines. The cryptocurrency ecosystem, meanwhile, navigated its own period of fragile consolidation, marked by strategic capital rotations and evolving institutional interest. The table on left provides a quick, at-a-glance summary of the major indices discussed, anchoring this report in verifiable data. The U.S. market, a tale of two narratives. The contrasting performance of the major U.S. indices, with technology soaring while the broader market stalled, can be traced back to a single, critical macroeconomic event: the release of the latest Job Openings and Labor Turnover Survey, JOLTS, report. This data revealed that U.S. employers advertised only 7.2 million job openings at the end of July, a figure that came in below forecasts. On the surface, a weaker-than-expected jobs report might seem like a negative signal for the economy. However, in the current market environment, it is often perceived as a bullish indicator. The rationale behind this seemingly paradoxical reaction is rooted in the Federal Reserve's monetary policy. A cooling labor market is a crucial precondition for the central bank to become more confident about cutting interest rates, as it suggests that inflationary pressures from wage growth are subsiding. This chain of events can be followed step by step. Weak JOLTS data signals a loosening of the labor market, which in turn reduces inflationary pressure. This strengthens the case for the Federal Reserve to deliver its first rate cut of the year at its upcoming policy meeting. The expectation of lower future interest rates is particularly beneficial for high-growth technology companies. These firms often have a high proportion of their value tied to future earnings, and lower discount rates make those future cash flows significantly more valuable. Furthermore, a lower interest rate environment reduces the cost of capital, which is critical for companies that rely on debt for investment and expansion. This direct linkage explains why big tech stocks, such as Alphabet, saw a massive rally, with its Class A shares surging over 9%. This technology-driven momentum was powerful enough to carry the Nasdaq Composite and the S&P 500 to positive closes, even as the more economically sensitive Dow Jones Industrial Average slipped, reflecting underlying concerns about the weakening economy that the JOLTS data also signaled. This macroeconomic narrative is also manifesting at the corporate level. While some companies like Campbell Soup reported stronger than expected earnings, they also warned that President Trump's tariffs could weigh on next year's profits. Similarly, Dollar Tree, despite beating earnings forecasts, saw its stock decline as analysts pointed to the risk of tariff-related cost pressures. These examples illustrate how political decisions are not just headline news, they are active, real-time drivers of corporate performance and investor sentiment. Central banks and monetary policy, the tariff tug-of-war. The Federal Reserve finds itself at a challenging inflection point, where its dual mandate of promoting maximum employment and price stability is in tension. As Chairman Jerome Powell noted in a recent speech, the near-term risks to inflation are tilted to the upside, while the risks to employment are tilted to the downside. This challenging situation is, in part, a direct result of ongoing political policies, most notably the implementation of new tariffs. Chairman Powell explicitly stated that the effects of these tariffs on consumer prices are now clearly visible and that they are expected to accumulate over coming months. The critical question for the Fed's monetary policy is whether this tariff-induced price pressure is a one-time shift in the price level or a catalyst for an ongoing inflation problem. The central bank's framework dictates that it must not allow a one-time price increase to become a persistent inflation issue. But the process of determining the durability of this new inflationary force is highly complex and uncertain. This uncertainty extends beyond inflation to the real economy. The policy ambiguity surrounding tariffs and other economic measures has made planning difficult for businesses and has left them hesitant to add to their payrolls. This directly connects the political policy of tariffs to the weak JOLTS data discussed previously, establishing a powerful causal narrative. It demonstrates how political decisions are filtering through the economy, creating a chilling effect on business investment and labor market growth. The Fed's policy stance, which is currently in restrictive territory, is not on a preset course and will be decided based on a careful assessment of this evolving data and the shifting balance of risks. Beyond the US, other central banks are grappling with their own unique challenges. The European Central Bank, ECB President Christine Lagarde, has renewed calls for lawmakers to rapidly introduce legislation for a digital euro, while the Bank of England, BOE Governor Andrew Bailey, remains unconvinced about retail central bank digital currencies, CBDCs. In Japan, a Bank of Japan, BOJ board member, has suggested that further adjustments are needed to its government bond purchase program, highlighting the ongoing global debate around the future of monetary policy and the role of central banks in a digital, post-pandemic world. Asia and India, navigating domestic and external forces. While global markets have been subject to a turbulent mix of economic data and political uncertainty, the Indian market has demonstrated a unique and fascinating degree of domestic resilience. The BSE Sensex and the NSE Nifty 50 both closed in positive territory, with the rally driven by robust domestic factors. This performance stands in contrast to the persistent selling seen from foreign investors and highlights the underlying strength of India's economy. The crucial dynamic at play is the stark difference in activity between foreign institutional investors, FIIs, and domestic institutional investors, DIIs. According to the most recent data available on Friday, August 29th, FIIs were persistent sellers, divesting equities worth 312.66 crore. However, this selling pressure was overwhelmed by DIIs, who purchased stocks valued at 11,487.64 crore, providing a crucial counterbalance to the global risk-off sentiment. This trend of DIIs acting as a net buyer has been a consistent feature of the market. While specific data for September 4th is not yet available, the most recent confirmed data from September 3rd shows a similar pattern, with FIIs selling Rs 1,115.48 crore, while DIIs purchased Rs to 495.30 crore. The positive sentiment among DIIs is rooted in India's strong domestic macroeconomic indicators. India recorded a robust economic growth of 7.8% during the April-June quarter, marking its strongest performance in 5 quarters and reinforcing investor confidence in the economy's resilience despite global uncertainties. This strong GDP data, coupled with optimism surrounding anticipated consumption benefits from a possible GST rate restructuring, has bolstered sectors like auto and consumer durables, which led the rally. This separation of narratives is critical. FIIs are largely influenced by global risk factors, such as the tariff-induced uncertainty in the US, which has made them jittery about near to medium-term prospects. Conversely, DIIs are focused on the local story of strong economic growth and supportive fiscal policies. This domestic-driven buying provides a critical buffer, insulating the Indian market from the full force of external headwinds and allowing it to chart its own course. The cryptocurrency ecosystem, institutional rotations and maturation. The cryptocurrency market is undergoing a period of significant strategic shifts, moving beyond simple price action to a more nuanced landscape of institutional and whale-driven capital rotations. While Bitcoin has shown resilience, trading near the $110,000 mark. Its footing is described as fragile, with some analysts noting a consolidation phase after a recent surge. The most compelling development is a high-profile whale activity. A single entity sold over $215 million worth of Bitcoin to acquire $216 million in spot Ethereum on the decentralized exchange Hyperliquid. This is not a random trade, it is a clear signal of a market rotation. It suggests that large, sophisticated investors believe Ethereum and other altcoins may offer greater upside potential from their current levels. This strategic shift indicates a maturation of the market, where capital is no longer solely focused on Bitcoin dominance, but is actively seeking out opportunities across a broader range of digital assets. Despite this short-term volatility and reshuffling of positions, the long-term institutional appetite for crypto remains robust. US spot ETFs continue to see fresh net inflows, reinforcing the growing mainstream acceptance of digital assets. Furthermore, a notable Japanese firm, Metaplanet, acquired 1,009 Bitcoin for approximately $112 million, bringing its total holdings to 20,000 BTC. This move underscores a long-term conviction in Bitcoin as a core treasury asset. A subtle but profound indicator of this market's maturation is the record-breaking market capitalization of tokenized gold, which has hit approximately $2.57 billion. This is particularly significant because it shows that traditional safe haven demand, which has historically been reserved for physical gold, is now finding a home in the crypto ecosystem. This development suggests that institutional and sophisticated retail investors are beginning to view certain digital assets as legitimate stores of value, a critical step in the ongoing institutionalization of the space. Political economy, a new era of state intervention. The political landscape is increasingly becoming a direct and palpable force in the financial markets. The commentary and actions of major political figures and government bodies are no longer just macro-level influences. They are shaping specific sectors and corporate balance sheets. For instance, President Trump's tariff policies have been cited as a source of uncertainty for critical exports, including textiles, and have already begun to manifest in corporate earnings forecasts. A broader and arguably more profound shift in U.S. economic philosophy is also underway. The U.S. government is increasingly acting as a direct participant in the economy, a move that can be characterized as a pivot toward state capitalism. This is demonstrated by several recent high-profile actions. The government has taken a 10% stake in the largest U.S.-based producer of semiconductors, an investment aimed at revitalizing domestic chip-making capacity. Similarly, the government approved a Japanese takeover of an American steel company only after the acquiring firm granted the U.S. a golden share, giving the government influence over future decisions. The Pentagon has also taken a 15% stake in a company that produces a mineral used in high-strength magnets. These developments signal a fundamental change from the free market principles that have dominated U.S. economic policy for decades. The government's use of subsidies and direct equity stakes represents a strategic effort to protect and bolster key domestic industries, particularly in response to perceived threats from foreign competitors. This new layer of state involvement introduces both new risks and new opportunities for investors, as political decisions become a more active variable in market analysis. The long-term implications of this shift are yet to be fully understood, but it is a compelling narrative for investors to monitor closely in the coming quarters. Conclusion: synthesizing the narrative and the road ahead. The past 24 hours in financial markets reveal a global landscape defined by complex and at times conflicting forces. The U.S. market's mixed performance was a direct reflection of a classic good news is bad news scenario, where weak jobs data bolstered hopes for a Federal Reserve rate cut, which in turn fueled a rally in high-growth tech stocks. This was a sophisticated reaction, demonstrating that market participants are looking beyond surface-level data to anticipate future monetary policy. Simultaneously, the pervasive and tangible impact of tariffs is becoming increasingly clear, as noted by Federal Reserve Chairman Powell himself. This policy is not just a political talking point, it is a real-time driver of inflation and a source of significant uncertainty for businesses, which is making them hesitant to hire and invest. In a world buffeted by these global headwinds, India's market stands out for its unique resilience. This is not a function of global sentiment, but a result of strong domestic fundamentals and the critical countervailing force of domestic institutional investors who have absorbed the persistent selling pressure from their foreign counterparts. Meanwhile, the cryptocurrency ecosystem continues its path toward institutionalization. The strategic rotation of capital from Bitcoin to Ethereum by large-scale investors points to a maturing market where participants are seeking new growth opportunities beyond the dominant asset. This is further reinforced by the growing market for tokenized gold, which suggests that traditional safe haven demand is now finding a home in the digital asset space. Finally, the U.S. political economy is quietly but profoundly shifting toward a new era of state intervention. The government's use of subsidies, direct equity stakes, and golden shares signals a new philosophy aimed at protecting strategic industries. This creates a new layer of political risk and opportunity that investors will need to navigate. Looking ahead, market participants will be watching for the outcome of the upcoming Federal Reserve policy meeting and the GST Council meeting in India, as well as the continued flow of data on corporate earnings and labor markets. These events will provide crucial signals about how these various forces will continue to shape the global economic and financial landscape. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget subscribe to our channel for such wonderful daily content. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor. Also, if you are interested to watch the videos in other languages, then you can also subscribe to EPK Capital's other channel. Thank you for watching.